Welcome to the Coldstream Investment Strategies Group third quarter market update call entitled Double Double Oil in Trouble. I am Howard Coleman, Coldstream's Chief Investment Officer, and here today with me is Darren Ritchie, the Portfolio Manager for Joe Cervantes' team and a member of the Investment Strategies Group. The call today will have two parts. The first part will be a third quarter market and economic update that I will present. The second part will be a look at oil and master limited partnerships, which Darren will present. There is a box on your screen where you can type in any questions you might have. We do have time constraints, so if we are not able to get to your questions, we apologize in advance and ask that you please convey your question to your portfolio or relationship manager. Turning now to third quarter market returns. Returns were significantly negative for virtually every asset class globally. The major factors causing these negative returns were really, number one, China and fears of emerging market growth slowing. The significant downturn began in August when China surprisingly devalued their currency by 2%. It wasn't so much the percentage decrease in the currency valuation that spooked the markets, but it was concerned that if they are devaluing their currency, there must be some more significant economic slowdown than people were considering, and markets were concerned about EM slowing down globally. Typically, when U.S. markets fall, or even when world markets fall, it's often led by a slowdown in the U.S. economy. In this third quarter, that trend really reversed as the slowdown was clearly led by China and emerging markets. And as we can see in these indices, the MSCI EM, the Emerging Market Equity Index, was down almost 18% and was down far greater than any other measurement that we show on this slide. The next furthest decline was in commodities, which are, in this day and age, greatly affected by Chinese demand, as well as the strengthening U.S. dollar. International developed equities also suffered at minus 10%, and in large part that's because Europe and Japan have far greater exposure to emerging market than the United States does. What was a bit interesting about this quarter was that small cap U.S. equities fell about 12%. That was really, in my mind, a mean reversion trade because it was in some ways counterintuitive, given that small caps are domestically oriented and really don't have EM exposure. However, many of them do have energy exposure, and that was the other significant story of this quarter. And of last quarter as well, and Darren's going to dive into that more, so I'm not going to spend a lot of time on oil and energy here. The one positive return was in NAREITs, which is REITs, which gained almost 1%, and they were the largest underperformer for the year prior to this quarter. And in large part, that was because the other significant event of this quarter, the Fed's decision not to raise interest rates. And given that REITs kick off significant dividends, they responded in the search for yield that has been going on since QE began. Here we see a chart of the S&P for the third quarter. We see the dramatic decline occurring in August that really began after China devalued. We also see an initial decline after the Fed came out and decided not to raise rates as people were concerned about slowing U.S. growth. We see a little recovery at the end of September, which, as you know, has gone into October. And that recovery was people realizing, well, maybe the Fed aren't raising rates anytime soon, and this should be good for equities. The small cap index suffered, as we said, a more severe decline and did not share in the significance of the bounce back. It bounced back a little bit, but it did not bounce back to the same extent that the S&P did. As we said, emerging markets have suffered significantly throughout the year, and this trend continued. The green line here being the emerging market line, and the top line being the S&P. And we can see that emerging markets significantly underperformed the S&P throughout the year and in third quarter as well. They did snap back at the end of September a little bit, and that snapback has continued into October, as I think the markets are saying that fears of a Chinese hard landing, although it's clear they're slowing down, but the fears of a hard landing may be a bit overdone. Part of the reason for the decline, not the sole reason certainly, but part of it is seasonality. There is clearly seasonality in the S&P returns, and if we look back since 1928, we see a 1.2% increase in the third quarter, and typically we see a very strong fourth quarter, and the equity markets are off to the races this quarter as well. So that seasonality has held. The one market that did not recover significantly toward the end of September was the high yield market. And we can see that here with the high yield being the yellow line. It did not fall as much as the S&P because it is a debt instrument. You wouldn't expect the high yield markets to tumble to the extent that the equity markets do in a sell-off. But you would expect it to come back to some extent, and it did not. This is in part due to energy and concerns about energy and the spillover to materials, but it's also in part due to a risk aversion that people are somewhat spooked by the debt markets. And the cause of this is a change in structure in the high yield markets that has occurred since 2008, where daily mutual funds, high yield mutual funds, the JNK being one of them, constitute a much larger percentage of the high yield market than they have historically. That causes more volatility, and the buffer that the banks used to provide by holding those high yield bonds in inventory to buffer market downturns is gone away because the regulatory impediments, risk-weighted assets, the penalty for banks holding risk-weighted assets discourages them from holding them in inventory. Commodities have been a wreck. As we can see here, they continue to be a wreck. This is in part due to China, especially for things like copper and iron ore. Part of it is energy, as corn has fallen as well, and we know corn goes into ethanol. Part of it is seasonality and strength of the dollar. For example, sugar is grown in Brazil, and the Brazilian currency has dramatically decreased with the US dollar strengthening, which has cheapened the price of sugar. So it's a variety of factors that have all coalesced into a dramatic decrease in commodities. Let's turn to fundamentals here for a moment, and let's talk about the Fed's decision not to raise rates. This decision was controversial. The market was split as to whether the Fed would raise or not. In fact, the Coldstream Investment Strategy Group had different views of this coming into September. They did not raise, but what was surprising about them not raising is that they seem to have changed the criteria they would use for raising rates or not. Now, I'm going to explain this, but I want to give you one caveat, which is today they seem to walk what I'm going to tell you back. But we've all been schooled, and U.S. statute requires the Fed to take two issues into consideration in setting rates. That's unemployment and inflation. And we've all known that there's been a pool between unemployment and inflation, with unemployment numbers looking very, very good, and they would indicate the Fed should raise, and inflation numbers not being near the 2% target, indicating they shouldn't. But what was new about this was the Fed included, and I quote, global economic and financial developments in their decision. And the Fed had never before articulated that global economies played into their decision. We did know that the World Bank and the IMF, the International Monetary Fund, both lobbied the Fed not to raise rates, but the market was surprised to see that language in their minutes and a bit confused about what that will mean going forward. Now, today, and I haven't studied what's come out of the minutes of the meeting that occurred today, but it has been indicated that they took that wording out and said that it's the domestic economy is what they will focus on. So anyway, let me quickly go through some of the fundamentals before I turn this over to Darren. Leading economic indicators continue to look good through August. As I mentioned, inflation is difficult. This is the PCE, the personal consumption expenditures, which is the Fed's favorite measure of inflation. It's similar to CPI, but not exact. Even excluding food and energy, it is declined. It's not near the Fed's target of 2%. Employment and wage growth, and here is, you see the dichotomy in one slide that the Fed faces. Employment is down, that's the black line, and it's decreased significantly. We are almost in a full employment scenario, and some would even argue we are in a full employment scenario. However, wage growth in the blue line, which seemed to start rising earlier in the year, has come back off, and that was a concern of the Fed. The dollar continues to strengthen, which makes our imports cheaper and creates the deflationary atmosphere. It also makes our exports more expensive, and we have seen that in the next slide, where our year-over-year exports of goods and services has turned negative, and that really is both due to EM slowdown and dollar strengthening. Here's the labor market, and this is job openings, JOLTS. This is also an interesting measure of the Fed that the Fed uses, and this is the conundrum that's facing the U.S. economy right now. There are job openings. Job openings are increasing. What we have is a mismatch between the labor force that we currently have and the types of jobs that are open and available. The government, which has been a drag on GDP, will now again become a wind at the back of the GDP as government spending begins to increase again, and that's what this chart shows. Households have delevered, and I think all of us can attest to the fact that the U.S. households were heavily indebted and delevered after the financial crisis. That delevering has leveled off, but we have not relevered, and households are in very good shape compared to where they have been historically, and certainly where they were before the great financial crisis. Turning to China briefly, China, because it is such a focus, both of the Fed and the world economy, we can see that industrial production has stabilized a bit. We did have, after September this month, industrial production number that was not so great, but it still was not the decline that we saw throughout 13, 14 in the beginning of this year. Chinese retail sales have actually bounced a little bit, and so we see continued slowdown in China, but we also see some stabilization. The IMF, the International Monetary Fund, articulates world growth forecasts, and they recently revised their world growth forecasts down. That also contributed to spooking markets in the third quarter, but it still is well above 3%. The bottom line is that fundamentals in the U.S. economy continue to look okay. U.S. looks like eventually it'll be raising rates, and it certainly looks like Europe and Japan will continue to ease, which will probably mean more pressure on the dollar to rise. When the Fed when the Fed will raise and at what point remains an open question. Apparently, they indicated today that December is back on the table, when I think 2 days ago the world, given their statement about global economic growth, thought it was off the table. Now I'm going to turn this over to my colleague Darren Ritchie, who will talk about oil.
Thanks, Howard, and thank you all for joining us this afternoon. I wanted to spend a little bit of time talking about oil, the energy markets, and master limited partnerships, which are our favorite vehicle in that space. I was in Houston a month ago at a conference on these topics, so we thought it would be a timely opportunity to share that information with you. In terms of what we've seen here in the U.S., energy production is dramatically different now than it was a decade ago. The landscape of the energy markets has changed dramatically. This chart of U.S. crude oil production goes all the way back to the 1950s, and we see from the 50s through the 70s a steady increase in U.S. oil output in places like Texas and Alaska. That production peaked in the 1970 period and then began a long, slow decline with one exception in the mid-80s that continued through the mid-2000s. As this decline was going on, there was great concern in the U.S. about our future as an energy importer, the fact that we were going to have to be importing more and more of our gasoline and oil from places like the Middle East that may not have our best interests at heart, and real concern that we'd seen a peak in U.S. production that was going to continue to decline in the future. That has changed dramatically due to technological developments, things like horizontal oil drilling and hydraulic fracturing. Some of these techniques are controversial, but their impact on U.S. energy output is pretty unambiguous, and we see that dramatic increase in a very short time period to within shooting distance of the all-time high from the 1970s. For a while, the global energy markets were able to absorb this new supply from the U.S. and from other areas, but beginning early last year and continuing this year, we've seen a dramatic increase in global oil inventory. Supply has outstripped demand, and therefore inventories are starting to pile up. And this was really, we think, the catalyst that triggered a dramatic decline in energy prices beginning about a year and 3 months ago. Initially, this inventory build was focused on the U.S., but now it is spread globally, and you can see fleets of oil tankers full of oil sitting in harbors at points around the world. The impact on oil prices has been, as one would expect, given that increase in inventory. This chart looks back about 15 years, and we can see the price gyrations around the financial crisis in 2008, a spike followed by a crash. But after a recovery from the post-crisis trough, we see a general increase in a steady trading range around $100 a barrel for West Texas oil. That was a fairly stable period for about 4 years, which triggered the pretty dramatic increase in energy investment that we saw over that period. And then we see this rollover and rapid decline down to the $45 a barrel or so range that we've seen lately. So that's been a pretty rapid price shock. We've only seen that kind of behavior a few times in history, once clearly after 2008 and then again in the 80s, but a historic decrease in the price of energy over the last year and a half or so. This has had a ripple effect on U.S. exploration activity. This chart shows the active rig count in the U.S. for a number of years in the past, and we see this thick red line for 2015 shows the rapid decrease in the amount of U.S. exploration activity. It's just not economical to drill for oil, natural gas, and other resources in many of the locations that were active over the last several years. In fact, if you look at the gray line in the background, what we see this year is quite similar to what we saw in 2009 as oil prices collapsed after the financial crisis. And we're continuing to see that slow downtrend in active rigs in the U.S. this year as oil prices are hovering around that $45 a barrel level. However, we also note that demand is responding to low oil prices. For example, this chart shows U.S. vehicle miles traveled, and we see a steady increase through the 2000s as people were driving more cars, more miles per year. That increase stopped and then reversed during the crisis, the recession, and unlike a lot of other measures of economic activity, it didn't increase much after the crisis. People continued to drive less, use more mass transit, other ways to reduce their vehicle miles traveled. Now we've seen as gas prices have tumbled in the last year and a half, that indicator has jumped up pretty sharply. Likewise, if you look at what people are buying, auto sales are way up. You've probably heard that. What may not be making the news is that car sales are actually very stable over the last year or two. That's the blue columns in this chart. However, truck sales, which includes SUVs, heavy SUVs like a Yukon, are up pretty dramatically over that period. And again, this is consumers responding to lower gas prices in changing their vehicle mix And unfortunately or not, memories are pretty short in terms of where gas has been recently. So what does this mean for U.S. production? Our partners at Chickasaw Capital, who put on this conference, have created their own forecast, which we think is pretty on point in terms of what the expected behavior of U.S. production will be. We do expect to see production drop as marginal wells are not producing or being replaced as they taper off. So we're likely to see over the next year or two a slow decline in U.S. production, followed by, if we do get a recovery in oil prices, we do expect production will bounce. There has also been a fairly dramatic focus on the part of oil producers to reduce their production costs, which should help production recover or at least remain stable in the face of decreasing oil prices. We also note that OPEC has been flooding the market with oil, in particular Saudi Arabia, but other countries are also producing as much as they can. In part, that's to drive higher cost producers out of the market. The U.S. was really the target of this effort, but the data we have shows that that effort is really failing because U.S. costs of production have come down significantly. The people on the bubble now are countries like Canada, Venezuela, Norway, places with a lot of offshore oil exploration that's very, very costly. So the U.S. has actually held up a lot better than other places in the world that are under extreme pressure. But OPEC can't keep this up forever either. This chart shows the oil price in the blue line required for those countries to balance their budgets. So for example, Libya needs $200 barrel in oil to balance its budget. Kuwait only needs about $50 oil, but we're below any of these figures in terms of the current oil price. The orange lines on the left show how long they can keep this up in terms of years of fiscal reserves. So again, Libya only has a couple of years of reserves to tide them over through this low oil price environment, whereas countries like Kuwait, Qatar, and the UAE are much better positioned, but they are not major players, at least to the extent of a Saudi Arabia. So we think OPEC has a strategy here, but they can't keep it up forever. If we look at the oil market on a longer-term basis, we think it's clear that oil needs to go higher in order to reach a supply-demand equilibrium. We were oversupplied over the last several years, and now we are entering an undersupply phase as oil wells expire, they taper off over time, and they're not being replaced. By 2020, if we look at the oil demand we think we'll need, another 30 million barrels of oil a day production on the horizontal axis there. And then if you compare that to the known cost curve in terms of how much it costs to produce oil from the world's known oil fields, you need about $70 an oil to make that amount of supply active by 2020. The longer we stay below that $70 figure, the higher prices will probably have to go in order to get us there. So this is one forecast. We've seen others from other researchers that show a similar conclusion. Oil, very hard to predict the price in the short term, but we think in the medium to longer term it does need to go higher to balance supply and demand. Now to talk more specifically about MLPs and how we use those in client portfolios, we want to start with a quick refresher on what is an MLP. Some of you have heard us talk about this, but if not, here's a brief explanation. MLP stands for Master Limited Partnership. And this is a tax structure that was defined by Congress in 1987. They promulgated rules on what is an MLP and what businesses can take advantage of that structure. MLPs can be traded on an exchange like a stock, but they're fundamentally a different kind of business. If you own a share of a corporation, typically income that corporation generates is taxed at the corporate level once by the corporate income tax, and then any dividends that are distributed to you as a shareholder are taxed again when you receive them. If you receive them in a tax-deferred account like an IRA, you will pay tax on those dividends when you eventually make withdrawals from your IRA. MLPs, however, are not taxed at the partnership level if 90% or more of their income comes from a qualifying activity, and one sector of those qualifying activities are businesses related to natural resources. From exploration to production, refining, distribution, marketing, all of those activities qualify. It's important to note that as an MLP investor, you are a partner in the business. You are not a shareholder. What this means is that you pay taxes on your pro rata share of the partnership's income, which can be different than the cash flow that is distributed to you as an MLP investor. If you own, again, a corporate stock and you got a dividend, that's what you're taxed on. You're taxed on the dividend you receive. Different with an MLP. Fortunately for MLP investors, most of that income is reduced or completely offset by the depreciation allowed by the IRS on the underlying assets, the pipelines, the drilling rigs, and so on. What that means is that you receive an income distribution that is largely tax-free. However, that distribution or that depreciation reduces your cost basis in the position. What all this does is it effectively converts the annual income tax you would have to pay on that distribution into a long-term capital gain that you only pay at the sale of the position. So it's a very efficient tax vehicle, given that capital gain rates are typically a lot lower than ordinary income tax rates for most investors. However, if you are owning individual MLPs, you will receive a K-1 partnership tax statement, which can be onerous to process. We use MLP funds like mutual funds and ETFs that block those K-1 statements, and therefore you only receive a regular 1099 report. So a little bit technical, but that's the background on what MLPs are and how they can benefit investors.
Now that we've talked a little bit about what MLPs are, I want to discuss why we think they are attractive investments currently. The energy landscape in terms of infrastructure can be divided up into three different stages. The upstream stage includes things like exploration, production, the actual drilling phase, getting oil out of the ground. Tends to be very sensitive to commodity prices, and as we saw earlier, right now drilling activity in the U.S. has decreased dramatically. MLPs are active in that space. We really prefer MLPs in the midstream energy infrastructure space. This includes things like transportation, storage, fractionation, which separates natural gas from the other liquids in a gas stream, such as butane, propane, and ethane, and also storage and some refining activities. That really falls within the midstream segment. And finally, you have the downstream segment, which encompasses distribution to consumers, sometimes at the utility level. Things like your local gas utility would fall into that category. A lot of those are utilities. There are some downstream MLPs as well. What we really like about midstream MLPs is that most of these assets are paid on a essentially fixed price basis, where an operator has a take or pay contract where they have a certain amount of capacity in a pipeline and they have to pay for that capacity regardless of how much they actually use. Certain other MLPs may have agreements where they get a fixed fee per barrel or gallon of oil or natural gas that they move through a pipeline system. What's less common and what we want to avoid is a situation where the MLP is paid based on the price of the underlying commodity or the value of the commodity. That leads to much more volatility and sensitivity of their performance to what oil and the other energy markets are doing. So midstream assets are definitely our favorite because of that relatively stable cash flow that they tend to generate. And there's also a lot of growth in this area in both a high and a lower energy price environment, depending on whether supply or demand is driving the picture. The only concern here is that a dramatic decrease in U.S. production as a result of lower oil prices could be problematic for the sector, as we'll talk about in a minute. In terms of the asset growth within this space, one example is the Northeast region of the U.S., which has had a dramatic increase in energy production in states like Pennsylvania, West Virginia, Ohio, the so-called Marcellus region, where natural gas and gas liquids production in particular has exploded over the last decade or so. What's happened is that a lot of the existing pipeline network was built to supply energy markets like Washington, Philadelphia, New York, Boston with energy from other regions, especially the Gulf, where we were importing energy and distributing it up to the Northeast. Now those existing pipelines have really been turned around because the market has more energy than it can use, and so we are reversing existing assets and supplying energy back to places like the Midwest and the Gulf Coast. But those assets are reaching capacity, and so as energy output continues to increase in this region, we're going to need about $30 to $35 billion of new infrastructure projects, so-called takeaway projects, to get gas and other resources out of the Northeast and into other parts of the country, including down to the Gulf Coast for export. So that's one source of demand for MLPs and the MLP type assets that we're investing in. Energy exports are also a topic of conversation lately. There's been a lot of debate in Congress and with the administration about whether the U.S. should actually be exporting crude oil and what that could mean to crude oil prices domestically. It's a hot topic politically. We think a bigger story is energy exports of non-oil forms such as propane, methane, ethane, other gases and gas liquids that are in dramatic oversupply here in the US, but they are much scarcer abroad. So for example, liquefied propane gas takes propane, liquefies it, puts it on special tankers, and then delivers it to other markets around the world, especially countries like Japan, China, and Europe, the European area. And the U.S. has a dramatic increase in propane supply. That's leading toward this incredible increase in export capacity, going from only about 200,000 barrels a day back in the 2012-2013 period, all the way up to an expected 2 million plus barrels a day toward the end of this decade. And you can see all the various MLP companies that are involved in these projects. The pipelines to get the gas to the coast, the facilities to liquefy it, offload it onto tanker ships, and then from there they sail off with the product. So a huge increase in U.S. export capacity in liquefied propane gas. Ethane is a similar story. In fact, almost an identical chart for ethane. Another source of demand for U.S. energy resources is petrochemicals. Petrochemical processes use raw energy feedstock, things like propane, ethane, methane, that are then converted into products that we all use, things like plastics and fertilizers. This is an example of a project under construction now. We took a field trip out to Mont Belvieu, Texas, which is about an hour east of Houston, and we could see this project, a propane dehydrogenation plant being built for enterprise product partners. And what this facility will do, I'm sorry if I bring back some unpleasant memories of organic chemistry, but it converts propane into propylene, which is a slightly different molecule. That's all this massive facility will do, and the scale of this picture, it doesn't really do justice to how big this facility is. That central tower in the middle of the image is about 400 feet tall, they told us, so close to the size of the Space Needle. It's just a gargantuan complex. When it's done making propylene, that propylene will be shipped across the street to another facility that's being built by ExxonMobil, which will convert propylene into polypropylene, which was one of the basic polymers that goes into plastics manufacturing. Everything from drinking cups to plastic furniture, plastic wrap, all kinds of different plastics goods use polypropylene as their feedstock. In fact, if you turn over your plastic containers and look for the number 5 inside the recycling ring, that indicates polypropylene. So there's been a tremendous increase in petrochemical demand in the U.S. because of the dramatic fall in input costs for these companies, and so there's dozens and dozens of projects like this under construction, particularly in the Gulf Coast region. MLPs, again, very active in this area. Enterprise Product Partners, which owns this facility, is one of the MLPs that our funds invest in. Given projects like that, the outlook for capital spending and for resulting cash flow growth for MLPs is fairly clear over the next few years. These projects are multi-year in length, and typically as they're being built, they are already under contract to the end user, whether it's an energy producer for a pipeline or a plastics fabricator for a dehydrogenation facility. So they're already under commitment, and as those projects come online, they are the drivers of future cash flow growth for the MLP sector. So again, despite the fall in oil we've seen over the last 18 months, that picture is still pretty clear in the near term for MLPs. It's when you get out into the late decade period, 2017, 2018, 2019, if we continue to see dramatically lower energy prices, and if that leads to less output from producers in the U.S., are things like these pipelines that are being built going to end up being underutilized? That is really the question that the market is grappling with. But to the extent that MLPs have sold off equally to, or in some cases even more than, traditional energy companies like an Exxon or a Chevron, that really doesn't seem to make sense to us given the underlying stability of their cash flows and continued growth of those cash flows in the near term. To that point, valuations of MLPs have come way, way off in the last 18 months or so. They, again, are down as much as the broader energy sector, which, again, is a little bit confusing to us. And as a result of that depreciation, we've seen valuation ratios at record lows, at least in the look-back period that we're looking at here, which goes all the way back to the pre-financial crisis period. So we're lower now than we were in the 2008-2009 period, and also in the 2011 period when we had the first Greek debt crisis, the U.S. debt ceiling fiasco, and other challenges to the global economy. This is looking at the price of MLPs adjusted for their distributable cash flow and expected growth in that cash flow. So it's a little bit like a price to earnings growth ratio for a stock, again showing valuations well below average and touching an all-time low over this time period. Given that outlook, we think that there's a couple of points we can draw from what's going on in the energy markets. The first that we want to emphasize is that despite the turmoil we've seen in certain sectors of the economy, low energy prices are undoubtedly a net positive for the global economy. The U.S. remains an energy importer, although our domestic supply has come up significantly. We still do import more oil, or we use more than we produce domestically, so lower prices help us. They also help countries like China, Japan, and the European nations, which generally are heavy importers of oil and other resources. And so low energy prices should be stimulative to growth in those areas. There are certain losers, of course, some of the emerging markets like Brazil, like Russia, Canada, of course, and Australia. Even though Australia is not a big energy producer, it's certainly a major commodity producer, and metals have done about the same as oil and other energy forms have over the last 18 months. So those regions are definitely seeing the impact of lower commodity prices, but on net, we think this is a positive development that should be stimulative to global growth. We also believe that energy prices are unpredictable in the short term. It's very difficult for anyone to say with any confidence whether oil will be higher or lower in a 3-month period or 6-month period than it is now. It's just a very volatile commodity that moves on any news about global economic developments, and often those are not predictable in the short term. We do believe, however, that in the medium to long term, the fundamentals mean that oil needs to go higher. Right now, it is fairly apparent to us, based on what we know, that we are below an equilibrium price in terms of longer-term supply-demand, and that the longer we stay at these low levels, the higher oil will probably have to go to catch up with that demand that we think it will exist in the next 4 or 5 years.
Midstream MLPs appear oversold given the stable earnings and fundamentals of those businesses. Some decrease would have been appropriate given the cloudy outlook for energy production, but we think the baby is being thrown out with the bathwater at this point. Finally, we should also note that the global supply growth that we've seen from places like the US, Canada, other relatively stable markets has reduced the risk of a geopolitical shock. If we look back to something like the 1973 OPEC embargo and the stagflation that caused throughout the US economy in the 1970s, the 2008 price spike that may have helped trigger the recession, the likelihood of those kind of events has decreased dramatically, and we note that oil prices remain low despite tremendous volatility in the Middle East from players like ISIS, Syria, and Iran. So we have a lot of US supply growth to thank for that dramatic improvement in global conditions. With that, we'd like to thank you for your participation. Again, if you have any questions, please feel free to submit them through the box on your screen. We would also like to note that this presentation is not a recommendation to buy or sell any particular security, and please contact your Coldstream relationship or portfolio manager if you have specific questions about your portfolio and what recommendations we would take there. We'll just pause for one moment in case anyone would like to ask a question.
So we don't have a question, but I wanted to ask Darren a question. You discussed the idea of countries needing additional sales of oil to meet budget, and them running significant deficits, Venezuela being probably the primary example, Russia. Won't they be incentivized to continue to increase production just to be able to generate revenue to make their budgets?
I think that's clearly the case, and if you look at a country like Russia that has a relatively high production cost compared to where oil is now, they are maximizing output to try and recoup on volume what they've lost on price. And I think that's actually part of the Saudi strategy, is to put these countries in a position where their only response is to produce more, but given the production costs in these countries, especially in places like Venezuela, Brazil, where you have a lot of offshore activity that's very, very costly, they are still producing at a loss. So essentially, no matter how they react, they are in a very significant bind in terms of their production. They may be producing each barrel at a loss currently to try and generate some revenue, but if that continues, they're going to have to shut down because every barrel they produce is actually costing them money in the long run. So it's not a good time to be one of these higher cost producers like a Venezuela, like a Brazil. Fortunately, in the U.S., again, a lot of this technology that we've seen has dramatically reduced our production costs, so the effect on our output is likely to be much lower. But that is one catalyst that should keep oil prices low for some amount of time until we reach a new equilibrium.
Thanks, Darren.
We've had another question about what will be the impact once interest rates lift off, and I'll let Howard address that from a broad perspective, and then maybe I will chime in very briefly from an energy perspective.
Sure. There's two issues with liftoff. Number one, when they first raise, I guess three, by how much they raise, and probably most importantly, what's the path of raising after the first raise? And the answers to those three questions are critical in determining what the impact's going to be. My suspicion is that if they raise in December, there probably will be some volatility around that because it's still an open question as to whether they're going to do that. But more importantly, in the long term, I would be surprised to see the Fed hike quickly. It will be a slow and gradual process. And if they do a good job in communicating, okay, we're going to raise 25 bips now, we might raise 25 bips next quarter, but we see a very slow pace to the raise over time, I think they may be able to avoid significant market dislocations as a result of it. If they miscommunicate the message, we could see more extreme volatility. My suspicion is that they're very cautious of this, that they will indicate it's going to be a very gradual and slow raise over time. In fact, after the first, certainly after the second raise, unless we see a significant kick up in inflation, I think we'll see a pause for a period of time.
In terms of the impact on energy markets, what the impetus will be from a Fed rate hike, we do think that really depends on whether that rate hike is triggered by rising inflation expectations. Energy is one key component, obviously, in the inflation picture, and as inflation has been running below expectations, a lot of that is because of weaker energy prices. So if the Fed raises based on certain indicators like tightness in the labor market, while inflation remains fairly low, that could be an impetus for further weakness in the energy markets. However, if we do see some sort of price recovery, that may spur a slight increase in inflation that would in turn lead the Fed to raise. So it really depends on the mechanics of what leads to that decision from the Fed.
That apparently is all the questions we have. Thank you very much for your time and listening today, and we will speak to you next quarter with our fourth quarter market update. Thank you.